Item 6, reporting entities have obligations to put in place Part A and Part B programs to do customer identification. In the future, there'll be obligations relating to ongoing customer due diligence that involves monitoring their customers and transactions, and they'll have full reporting obligations. So that's reporting of threshold transactions, international funds transfer instructions, and suspect matters. Item 54, reporting entities have much more narrow obligations. They're obliged to have a Part B program which involves identification of customers, and they're obliged to report suspect matters only. Item 54, reporting entities could be members of something called a designated business group, which means that they would work with other reporting entities in fulfilling their obligations and may be relied on by other reporting entities in terms of identifying their customers. The new legislation takes a risk-based approach. I think that's very important to remember, which means that you identify, manage and mitigate your own risk, and there's flexibility to suit your program to your own business.
Liz, does that then mean that we really have a situation whereby brokers have an obligation that is going to be embellished by December 12? There'll be a certain regime for a period of time, and then that is going to then be the benchmark be lifted again, so there'll be a high level regime, and the actual compliance issues will not just be for the one loan that somebody does today, but maybe for the next loan or even the next loan. So every time the client maybe revisits their lending structure, in essence the due diligence starts again. Would that be correct?
That's absolutely right. By the 12th of December this year, reporting entities will be required to put in place their programs and to identify their customers. By the 12th of December next year, those obligations will be extended to ongoing customer due diligence, which will mean that you need to monitor the whole history of your relationship with the customer.
Tim, Deloitte's being a global leader in the field of compliance. How do you see that this is going to be affecting, or the legislation will be affecting, the financial community?
Well, it has a pretty broad impact on the financial community, not only in Australia but already globally, and we see that effect in the way the legislation here in Australia has been designed, because it's really saying to financial institutions, it's your obligation to help us fight the business of crime. And the reason that it's your obligation is because it is a business, and the only way the criminals can get profit out of that business is to be able to get the money in and then withdraw it again in a clean form. So it has a very significant impact on Australian business. Most big financial institutions, the large banks and lenders out there now, are already actively starting to produce programs. So they've generally started with some education of their own people in what money laundering is and how to detect it. They've moved through from there into programs which include risk assessments, working out which customers are at risk, which parts of their business are at risk, which geographies are at risk. And then they've moved from there on to the development of processes to identify inappropriate conduct and potential money laundering. And they've also started to put in some technology tools which actually help them detect that. Now, that's certainly quite significant for big players like the big banks, but it also flows on, that same structure flows on down to all levels of people involved in the financial services business. So that sort of structure around knowing where your risks are, educating your people, having some processes, and then having some tools to identify them is really consistent, no matter how big you are.